Hello everyone, welcome to another market update. Today is Tuesday, the 4th of August. Since I got back from my US trip on the 27th, it's done almost nothing but rain here in Sydney. It's been, sounds like it's been that kind of winter, unfortunately, but nevertheless, we are getting close to the end of it now, and of course, getting into the back half of this year. So more exciting things to come. Top three things today are Fed rate cuts, so US Fed rate cuts, which I'm going to talk about. Russell earnings, so the Russell 2000, which is the small cap index. Going to talk a little bit about that, some exciting things there as well. And then just kind of cover off some of the economic data and the overarching macro environment globally, and then also specifically in the US and Australia. So let's start with the Fed rate cut. So what happened on Friday is we had a massive market sell-off. I think the market was broadly down 2 to 3% that day. This is the S&P, the NASDAQ, etc. Big sell-off. And the reason for that sell-off mainly was that we had a bad U.S. jobs report. So you might have seen, if you follow any of the financial press, you might have seen where Donald Trump fired one of the Bureau of Labor Statistics people, I think the person that did the work on the jobs report. I didn't read the article or anything about it, but suffice to say he was not happy with the number. And it is actually, there is some truth, I should say, to statements he was making about the number being made up. It actually is, for the most part, a made up number. It's estimated, and there's all sorts of weird seasonal stuff that goes on in it. I mean, could you imagine them trying to actually physically count jobs in the United States, those created or those lost? They have to use statistic measures to estimate that. In any case, that kicked off a whole sort of panic session, I think, in the stock market, and that's what we saw on Friday. It was actually a great day to buy because, and I'll talk about this shortly, because we are again in that quad 2 and 3 environment in the United States, but also economic conditions are pretty good. The jobs report, just back to that jobs report for a second, and the link of the tie-in to the Fed rate cut. The jobs report was what you would call a dovish report. So if you might have heard the term dovish or the term hawkish, what that refers to is when we get numbers that are dovish, it means that maybe the economic conditions might be a little bit softer than what you thought, or inflation numbers, for example, if they're going down, then that's dovish. It basically means that it's a reference to the Fed and their ability to cut rates, or that they might have to increase rates. So a dovish report means that rates will probably be cut. A hawkish report or a hawkish event would mean that rates may have to go up. So that jobs report was dovish, and it will probably give the Fed enough cover to do a September rate cut. The other thing that's going to give the Fed cover to do that is the fact that the inflation data is now going to slow down. This is in the United States. The inflation data is going to start to slow down incrementally in the next month or 2 months. So that's going to bode well for the Fed being able to institute a rate cut in the United States. And that, of course, will probably get a few things going. Certainly the stock market will continue to run based on that. The bond market has already priced that in, so you may know that I often talk about the bond market being very smart about understanding economic conditions and pricing those in, and where you see that is in the interest rates that are being charged on well, across the yield curve, but certainly on your 2-year, your 5-year, your 7 and 10-year government securities. The bond market sets the price of those things, because as bonds fall in price, interest rates go up, and as bonds go up in price, interest rates go down. The two things are inversely correlated. If none of that means anything to you, don't worry about it. All you need to know is, really in summary, is we had a dovish jobs report, which should allow the Fed to cut interest rates in September. And I think they sort of come out and said, they came out and said they were going to do that anyway. So the Fed is already intimating that it's going to cut rates in September. And that's why we've seen a nice bounce and rebound in the markets overnight in the US on Monday, and Tuesday we'll probably have some follow through. And again, that's why it was a great buying opportunity to purchase equities in the United States, in particular the growth equities and some of the other big names in the Mag 7, like Amazon is a good example of that. So flowing on from the Fed cut that's coming up, the other good piece of economic news, if you want to call it economic news, that's come out is we're in earnings season. So what that means is a lot of companies are reporting their last quarter's earnings, and reports are quite good. You would have seen a few companies. Meta was a recent one. Microsoft has come out as well, beating previous earnings in the previous quarters and exceeding the earnings estimates from analysts, also giving positive guidance going forward. So again, that means the underlying economic conditions have improved or improving and continue to improve, and I think that's likely going to continue. But one of the parts of the market that has really been kicked around badly is the small cap sector, and one of the best representations of the small cap sector is the Russell 2000 index. That's an index of 2,000 small cap stocks. The ticker symbol for that, or one of the indices that tracks it, is IWM for Mary. That's the Russell 2000. So far, about 710 companies in the Russell 2000 index, which is about 30% of the index, have reported aggregate earnings growth of 20% or more. That's a really good sign. And what it means is that when your small cap companies are now starting to see their earnings improve and their conditions improve, that just bodes well for the whole market itself. So the Russell has been a much maligned segment of the market. Small caps have been really hammered since the cycle turned a year or so ago. The Russell 2000 has still not recovered the level that it was previously trading at in the top of the last peak of the cycle, or the peak of the last cycle, I should say. And so there's still a ways to go for that. Luckily, I haven't really owned any small cap exposures for quite some time, which is great, but I have put some on. So we've got the Russell Growth, which is ticker symbol IWY. I've got the Russell 1000 Growth, I believe, that's in there as well, which is the IWN for Nelly. And then I've just recently added the IWM. So just looking to broaden that exposure to portfolios to capture what I think will be a continued rally in those stocks. The other interesting thing about the Russell is it is the most short position currently by the major players in Wall Street. So what that means is, and I won't show you the table, but sometimes I show this CFTC, which is the Commodities Futures Trading Corp. It's a government or non-government body, and they track all of the futures contracts and options contracts on futures. And the data is often telling about how big players in the market have positioned themselves. And so what happens there, just very briefly, is when you go to extremes of positioning, that is often a sign that we are at market turns, because it's like if you're on a boat, if you imagine yourself in a little tinny and there's 3 or 4 people in it and it's a small boat and everyone goes to one side, what's the boat going to do? It's going to tip, and then eventually it's going to take on water, and then it has to go back the other way. So a little bit of analogy there, but that's what happens oftentimes when you get extreme long or extreme short positions. It's a sign of over-aggression in that particular, whatever that space might be. So in this case, it's in the Russell 2000, and it is the most short it's ever been, and it is the most consensus short trade in the market at the moment. What does all that mean? Well, it means that there's a lot of runway now for the Russell 2000 and then all the subcomponents of the Russell to have a really good run into this quad 2 and quad 3 environment. So that's why I've put more exposure onto the Russell, the Russell 2000 and the various subsections of that. Okay, finally, let's just touch on economic data. So, actually, before I move on to economic data, I'll just quickly touch on the VIX, because I always talk about the volatility index, and I just wanted to show you what happened on the on the Friday when the VIX spiked. So this is the big spike in VIX. So we were trending nicely down, and the VIX, of course, is the S&P 500's volatility measure. We are in the investable bucket, and we're in the investable bucket well and truly right up until the 1st of August there, and then we had that jobs report, and the market just, I don't know, for whatever reason, sometimes the market just has this pent up emotion in it, and it expresses itself, in volatility. And so we had a big spike in volatility. Nothing to be concerned about because we've come into that investable bucket. This was a kind of an anomalous situation. Again, a great buying opportunity because it's trending down. Economic data is trending up. A lot of the things I just explained meant that this was an opportunity for me to allocate more capital into the market, and which is exactly what I did. And of course, we saw volatility come down big time overnight. So it closed at, where's my thing? Closed at 20, just over 20 on the Friday, and then here on the Monday trading session in the U.S. it closed at 17. So right back into the investable bucket. I would expect to see volatility continue to trend down. We also had Trump out there doing, some more on tariff stuff and a little bit of chit chat from him, which, always tends to cause a little bit of short-term volatility. But again, you can't fight economic gravity, I suppose. And right now, economic gravity is very supportive of continued rally and so forth. So, economic data. I do want to just quickly touch on some of the economic data again to reinforce that. I do have a mid-quarter update coming up from Hedgeye, which is going to be this, I think, Thursday, so Wednesday, but Thursday our time. So I'll get that. I will get that reviewed and probably leave an update on that come Monday. So just quickly to review where we're at. Again, the quad count here, we've come out of a quad 4 environment. July was a quad 4 environment, and we did have quite a bit of volatility in that month. The tariff tantrum stuff continued, and I suppose the 1st of August was kind of the last hurrah of that quad 4 environment. It was a quad 4 day on Friday. That's exactly what it was. But we're now, getting right into August, and it's going to be interesting to see how the month of August continues to unfold. Again, it's a quad 2, which for those of you who are new to all of this, that's a Hedgeye thing, and the quads are real. It's where you have the 3 economic factors of growth, so GDP, inflation, and interest rates, all doing something directionally, which is either conducive to growth or is a detractor from growth. The quads 1, 2, and 3 are all generally going to have some positive growth. Inflation is the kind of the wild card in there, and interest rates in the 3 quad setup. Quad 4 is just generally bad. That's when we have deflation, poor growth, and interest rates are usually declining as well. So here we are in a quad 2 and 3 environment for the next 4 months. Again, this should be conducive to seeing the stock market and equity markets continuing to rise over that period of time, and then select parts of the market probably doing even better. Again, I've highlighted before technology as a great exposure to have on here, but also now with that small cap stuff that I just talked about, we want to have those exposures on, which we do. The thing we're going to have to kind of deal with and discount, I suppose, is when we get into November, seeing what the market is doing and seeing what the market begins to anticipate for this quad 4. So there's a lot of water that's going to flow under the bridge between now and then, so I'm not going to get too worried about this December quad 4, but certainly if you can see this chart on a conditional a sort of mathematical basis, there's about a 70% chance we're going to land in quad 4. Could be very shallow though, which really means that there's probably nothing to do, because as you can see, once we get into 2026, we have a whole slew of quad 1s and 2, a quad 2 and a quad 3 in there, but a slew of quad 1s, which really is going to continue for us to have that runway of great economic performance, which is, I think, will translate into great stock market performance. The last time this sort of thing happened was right out of COVID, where we had 6 consecutive quarters of growth. I think they were all quad 2s, and we put on a tremendous amount of alpha and gain in accounts during that period. So again, that's what I would be anticipating to occur. But yep, as I say, a lot of water that has to flow under the bridge between now and then. Anything can happen, and literally, I mean, anything can happen. So we just have to be vigilant, keep our eyes on our fries, as it were. The final thing I think I wanted to touch on was the quad map for, let me see if I can find it, for Australia. Where did I have that a minute ago? Because I did want to touch on, yeah, here we go. So this is like a global quad setup. Let's go plus. Okay, I just want to highlight Australia. This is quarterly, so again, Australia has, again, some great runway as well for the next 3 quarters. We have quad 1 and 2 environment, and 3 by the time we get to the middle of 2026. But certainly similar situation, probably tied to a little bit to China, because China is having some, a bit of economic growth now, but they also have inflation that they're dealing with. But in any case, Australia looking really good with growing GDP numbers through the rest of this year and early 26. And then inflation in Australia, I think this is the thing I wanted to highlight, actually, is the reason I put this chart up here. Inflation in Australia isn't coming down. In fact, it may be reaccelerating. And this is going to be interesting to watch and see what happens, because the RBA here in Australia has been, I think, very good at managing the interest rate situation. They have been very data dependent, which I'm so pleased that they have not bowed to the media is constantly, and the big bank economists are harassing the RBA, constantly saying, oh, you got to cover for a rate cut now, all this crap. But the reality is that if they cut rates too soon, it can reignite, or probably not reignite because we already have inflation, but it could stoke inflation, which will put them in a really tough spot. So I think they're being very prudent, the RBA, in just waiting and seeing. And will we get a rate cut by the end of this year? I don't know. We'll just have to wait and see. It's really just a month-by-month proposition as to whether we will see that. If I was a betting man and you said, PJ, if you could probability weight, will we get a rate cut? I'm probably going to say there's a 25-30% chance that we'll actually get a rate cut. So in other words, I don't think we'll see one this year because, again, the economic data is improving, which is not suggestive that we need to have a rate cut because the economy will be improving. And then secondly, inflation will continue to be sort of elevated and probably a little bit sticky, up around that 3% range. So I think the RBA, in light of that, is going to say, well, until we actually see interest rates getting, inflation rates getting closer to 2, then they might not be too willing to cut rates. So anyway, I've said that. We'll see what happens going forward, and yeah, leave it at that. Final thing I quickly want to say, first of all, thank you for watching this video all the way through. We're almost at 18 minutes. We are in the process now of getting a few things happening. More regular reviews, so Princess and Lady will be reaching out. Princess is back from maternity leave now. And Shannon has just been on a couple-week holiday as well. So the full team is back full-time as of next Monday, and we'll be cranking through a number of things, getting reviews done, looking at moving. I noticed the other day, first of the month, I ran a cash balance report. We've got a lot of cash sitting in accounts because of the interest that's coming through from the Keystone Cash Flow Fund investments to many of you, and so we need to redeploy that. I want to probably get a lot of that cash now going to the equity space as opposed to staying in the fixed income side, although I do like that barbell approach where we have sort of a locked-in return in that space with the KCFA. I want to now get a bit more alpha and juice going, so we'll likely allocate some of that capital across to that. So stay tuned for that. I'll be in touch with people to do those things, and then just checking in on things that have changed with life. For some of you, things might have changed. I know I've been talking to a few clients where some health issues have come up and other cool things are happening. Well, that's not cool, but other cool things are happening in their lives with kids and things like that. So anyway, I'll look forward to catching up with all of you and making any changes, or yeah, that's it. Making any changes to portfolios and stuff for you. Okay, with that, I'm just rambling. So with that, I'm going to say enjoy the rest of your week. I think the rain's coming back here tomorrow, the next day. Looking like it's going to be a wet weekend. But anyway, have a great rest of the week. If you do have any questions, sing out. You can always book yourself in as well to my calendar using the link to book yourself in my email footer, or you can contact the team at intrepidwealth.com.au. And have a great rest of the week. Thanks, everyone. Bye-bye.